Hello, this is the Chart Profit video, Friday 5th of January 2018, a few hours pre-open. Looking here at the pre-open report, this is the E-mini S&P we're looking at. Last week on Friday, 2-month controlling price moved up to 26.88, which is here, and you can see that following that on the Tuesday and the Wednesday we have aggressive buying. That's the green at top, marked here and here. Indication of significant buying above that migrated point of control. All three value areas this week generated above that level. As I've been saying this week, first sign of weakness now would be significant selling. That would be red, marked below 26.88, this level here. Here's the breadth indicators for the New York market chart through Thursday. These bottom two indicators well above the levels that give us supportive readings. And that means that on the pulse chart, this middle section here representing the breadth for New York remains green, which is positive, and the bottom indicator based on price oscillator indicator, which gives us an idea of momentum, that remains above zero. Therefore trend by this indicator is up, and momentum has just turned back up again. Coming out of this ranging consolidation period here through middle July through August, you can see the indicator turn back to positive at this point, early September, and we've had a pretty strong uptrend since then, with these bottom two indicators giving us the confirming green color. In that kind of environment, you can see the green bars, which represent significant buying, which we mark on the profile. None of those, the lows of those green bars have been broken in this uptrend, again indicating that when aggressive buying is marked, it's also effective. Just back to the E-mini here, just again, first sign of significant weakness would be aggressive selling, marked below this level, 26.88. That's the migrated controlling price. So far no indications from price itself of any weakness, but if we look here at the sentiment indicators, we can see some warnings. This is my new version of the RIDEX assets ratio, recently updated and backdated the funds included, and the data looks very similar to the previous version. We hit a new high for the indicator here in late October, and very recently we've hit a new high again, actually last Thursday, here at 22.27, and historically when we've seen this indicator reaching new highs, it's been a warning for the market. This indicating that in the funds that I follow from Guggenheim or RIDEX, bull funds carry 22 times the assets that the bearish funds carry. Looking back at the historical data, we could describe that as kind of off the charts extreme reading. Whenever we approached high readings during the first few months of 2017, I noted that the total assets here were relative to history pretty low, but you can see that's changed as well. So it's not like we have low participation now. So total assets right up here, those being daily charts. If we look now at weekly, and I'm isolating the bull fund assets that I follow, this is extreme high readings in the bull funds. And again on this weekly chart, looking at years of data back to 2009, looking at the bear fund assets in isolation, really extremely low at the moment. So lots of bulls, very few bears in this data. Seeing something similar this week in the public poll from AAII. The bulls percent reached 59.8% this week, 59.8% bulls. That's a 7-year high this week. And the bears percent, that fell to 15.6%. That's a 3-year low. So the net, the bulls minus the bears, at 44.2, that's the highest since April 2004. Investors Intelligence poll, actually the bulls percent was lower this week, 61.9. That reached an extreme reading 8 weeks ago, actually at 64.4. Bears percent this week was higher at 15.2. That means the net, again bulls minus bears, at 46.7, down from the level reached 8 weeks ago at 50, which was the highest since 1987. One indicator, sentiment indicator I follow, which has been out of step with those extreme readings, is the data from Lipper US fund flows. I record the flows each week, the net inflow or outflow, and we also look at a 4-week flow number. And you can see here that Lipper US fund flows reported equity funds, including ETF, outflows this week, the week to 3rd of January, at $8.4 billion. You can see that here, that single red histogram reading below zero. We also note that the previous week there was actually a very large net inflow here at 24.1 billion. That was the largest single week inflow since January 2015. But again, the week prior to that, we had a really huge single week outflow down here at 22.2 billion. So as I mentioned here, that's pretty volatile. The current 4-week flow number is a negative 22.7 billion. That's a total net outflow over the last few weeks, 4 weeks. But just to remind you, that actually fell to a negative, the 4-week flow fell to a negative 33 billion just 2 weeks ago. And as I say here, that was the lowest since February 2008. And again, historically, if we see 4-week flow numbers this low, that usually indicates either bottoms in the market after a sell-off or at least fuel for higher prices, which is what we're seeing at the moment actually. So this indicator the last couple of weeks very much at odds with the other sentiment indications that we're recording. Nevertheless, a new high in the Ridex ratio is always something to note, and very often a warning for the market. Okay, this is the current chart for the Spyder, and we can see that a 4-month controlling price has emerged here at 267.18. That is now first level support. Pretty much corresponds with the level we've been looking at on the E-mini S&P. So price below here would be the first indication of weakness on the daily time frame. UK's Footsie 100 chart is confirming strength by breaking out above its previous peak. New all-time highs for this index. The big support here is 74.13 down here. That's the 18-month controlling price. And there's a useful development on the DAX chart whereby the 18-month controlling price migrated higher to this level, just above 13,000. The 8-month was down here somewhere, which was way below current price action, but we've now seen that migration, and pretty quickly after that happened, which was in here last week, we saw a dip, tested the previous low, and we're back above that level. So this is solid support to monitor here, just above 13,000 for the German DAX. Let's just have a look back in the pre-open, the comments I've made over the last few days with regards to TLT, the T-bond ETF. I looked at a 30-minute basis sampling rate, and I noted that the 15-month controlling price, which is significant, has just migrated to 126.66, and I said here if price remains below that level, which it is at the moment, it could be a negative. I'd much prefer to see TLT printing back above this level. So here's the current chart. The major, as we know, is down here, but the 15-month has now migrated up to this level, and can't say relative to this low and this high that that's a very encouraging place for that controlling price to migrate to. So the fact that we're printing below that level, which is always a weak price location in my opinion, some analysts call it an opportunity below value. I call it weak price location, so I'd much rather see TLT back above 126.66, put itself back in a strong price location before looking at the long side possibility of further weakness. So whenever we see a migration of a controlling price on any time frame of importance, and here we're looking at 15 months, we often see quite quickly after that a directional move, and the fact that it's printing below that level makes me a little wary here of T-bonds. I've made that point often in the past, and we have here an example in the oil ETF USO, and I've been commenting as follows for a while now. The major point of control recently migrated higher to 1141, and then I say the migration of a major controlling price often precedes a directional move. So that migration occurred in here after a pretty dull consolidating period. The fact that the major moved higher, not always bullish, but you need to monitor price relative to that level because it often precedes a directional move, and we have oil moving from that point pretty swiftly higher. So overbought it may be by most technical measures, but as long as that major stays at 1141 and price stays above it, I assume we're in an uptrend here. Comment for GLD, the gold ETF, the major point of control, again recently migrated back up to 121, and currently the chart prints above this level in a strong price location. If you recall, the major was up here at 121. It then at this point migrated back down to 119 last month with a little bit of time spent here. That point of control fell back down to that level, and then GLD immediately started to rally. At this point here, the point of control migrated back up to 121 or just below, and accelerating higher at the moment. There's now room for GLD to correct from here and still hold a really strong price location above that level, 121. A lot of that strength obviously to do with the weakness in the dollar index. Just to recap, when the index fell below the major, which is 95.50 at this point, we noted that's a really weak price location. The 8-month migrated lower down to this level. And following this low here in September, there was a rally back, but as I mentioned all the way through this rally, even at this point here, until the dollar index, and there were a lot of calls for major low here in the index, but I said unless and until the dollar index printed back above 95.50, the major, we couldn't assume there was a major change in trend here. Subsequent to that, we've fallen back below this halfway point here, which is from this low to this high. Let me clear some of this. So from this low to this high, we always mark the halfway point from a low to the first high, and we're now back below there, which puts the dollar index in a really weak price location, suggesting we'll see a retest of this low. In the longer term, just to reiterate, unless we see price back above 95.50, and as long as that major stays where it is, it looks unlikely to migrate at the moment. Dollar index is still looking like a really weak chart. And we can see that reflected in these charts. Firstly, the Euro FX chart, which, just recapping back, broke above its major at this point here at 113.29. You had a little kind of higher low at that point, and then a rally. And across this period here, we saw a 1 year develop at 117.55, and we've just found support there and rallied almost to test the recent high in September. So this is a strong looking chart. Pound dollar is a strong looking chart. Got this level here at 132.34, which is the halfway point off what I call the Brexit high to the low. We saw clear resistance at this point. Not as important a level to monitor in my opinion as the 9-month down here. So as long as the pound dollar chart holds above 129.25, it's in a long-term price location, and very rarely draw in the trend lines, but you can see there's a clear trend line which sort of comes into play here, I suppose. We've got two initial points here, and then the first touch here and again here. So somebody, a lot of people, I'm sure, noting and following this as support. To me, first level support is here, 132.34. Big support, 129.25 down here. Finally, the dollar yen. Major up here at 113.70. So we had a test here, and here. There was all probes above that level, and then we've had two rejections precisely at that level in December, and we're kind of at the moment between that point and the next important level, which is the 2 year down here. Proven support at this point at 111.30. So after this kind of coiling activity here, breakout one way or the other, above or below these two levels, will likely indicate the next directional move. Dollar rallying back a little in the last couple of days relative to the yen, just likely due to the sort of risk on attitude we've seen over the last few days. Okay, that concludes. Once again, I wish you a good weekend and thank you for watching.